Welcome to the deep dive. So you've handed us this stack of financial reports from Apollo Tyres Ltd, or ATL,
hmm
and it's all focused on their Q2 results for the half year that ended September 30, 2025. And I have to say, this material is, well, it's dense. It covers everything from domestic sales to these huge global restructuring decisions.
Well, a lot to get through.
Right. So our mission today is to cut through that data dump. We're going to find the core story here. What drove this really stellar performance this quarter? What are the big strategic pivots they announced?
And how does the balance sheet look? I mean, how does it hold up after absorbing what is just a huge necessary cost?
Exactly.
And when you analyze a massive multinational like Apollo, you're really looking at two different engines running at once.
Okay.
You got the high-growth domestic engine, that's India, and then you have this very complex, cost-sensitive international engine, which is mostly Europe. And this report, well, it shows those two engines are performing wildly differently.
Yeah, and the headlines are definitely mixed. On one hand, you see some of the strongest growth the company has posted in years,
Oh.
a clear win for their premium product strategy.
Why?
But the financials are just dominated by this one strategic decision that it's essential for their future, but it is incredibly expensive right now.
That's the heart of it, that duality.
Okay, let's unpack this. Let's start with those consolidated financial headlines for Q2 FY26.
Let's do it. And let's focus on the Q2 metrics because they tell a really incredible story of operational strength.
Go on.
So, consolidated revenue. It clocked in at INR 68,311 million. That's a solid 6.1% increase year over year. Steady growth.
Steady growth, yeah, but the real star of the show for me is the efficiency. Earnings before interest, tax, depreciation, and amortization, the EBITDA. It jumped to INR 10,207 million.
Which is a substantial 16.3% increase year over year.
Right. That 16.3% growth is more than double the revenue growth.
Yeah.
And that is a major sign of health.
It absolutely is. And what that did to the profitability ratio is key. Their EBITDA margins hit 14.9%.
So for you, the listener, that's an improvement of 130 basis points year over year. And just to be super clear for everyone, when we say basis points, we're talking about 0.01%, right?
That's right. So 130 basis points is a 1.3 percentage point improvement in their operating margin.
So what does that tell us?
It tells us they got significantly better at controlling their costs. Raw materials, manufacturing, labor, all relative to the price they're charging for the tires.
And here's where it gets really interesting, connecting the numbers to the company's own story. ATL registered its highest year-over-year growth rate in Q2 FY26 over the last 10 quarters.
Wow.
A 2.5-year high watermark for growth.
That is the ultimate
Yeah.
moment from their investor presentation, isn't it? This isn't just, some cyclical growth. It suggests the internal strategies, the cost discipline, the product mix changes are starting to pay huge dividends. Q2 was a breakout quarter.
And looking at the total half-year picture, the year-to-date performance, it's clear that Q2 did all the heavy lifting.
It really did.
YTD revenue reached INR 133,918 million, with YTD EBITDA at INR 18,885 million and a margin of 14.1%.
Strong, stable numbers. But the momentum was undeniably concentrated in that second quarter. Precisely. Now, those headline numbers look fantastic, but success always depends on where that money is actually coming from.
Which brings us to the operational drivers. The company cited an encouraging demand recovery, particularly strong growth spurred by favorable government policies in India, like GST rationalization, and a recovery in exports.
And we can see that in the revenue mix for the first half of FY26. Apollo Tyres is still heavily anchored in its domestic market.
How much?
India accounts for 64% of consolidated revenue. Europe is next at 28%, and then the remaining 8% comes from other regions.
And product-wise?
Truck and bus is still king, dominating at 40%, but passenger vehicle is significant. That's 22%.
But the real narrative of this quarter, I think, is all about their success in premiumization. They specifically highlighted the results of their dual brand strategy.
Yes, and this is a big one. They registered the highest ever Vredestein volumes in Q2 FY26.
And Vredestein is their premium European brand.
Exactly. Seeing record volumes there is a massive validation of their whole move up the value chain.
And that payoff isn't just in Europe, is it? We see it shining in the India standalone performance.
They do. The standalone Q2 FY26 EBITDA margin reached 15.3%. Now compare that to 12.1% in Q2 of last year.
Wow, that's a stunning 321 basis point increase just domestically.
It is. That's pure cost control and high-margin product success coming together in one number.
And their domestic premiumization journey, they actually quantify that with their product mix. Their ultra-high performance, or UHP, mix for the quarter stood at 49%.
Up from 46% last year.
So nearly half their passenger car tires sold in India are now these higher-end UHP tires.
Which is key. These are the higher spec, higher margin tires, getting that close to half their volume into the UHP segment. Well, that's the engine driving those margin improvements. They're just selling better, higher-priced rubber.
So that's the India story. Robust demand, margin expansion, successful
A
premiumization.
very good story.
But Apollo is a global business, and when we turn our attention to Europe, the narrative gets, well, a lot more complicated. If Vredestein is doing so well, as you said, with those record volumes,
Right.
why are we seeing a margin decline in the overall European segment? Is Vredestein's success being completely offset by other problems?
That's the critical observation. When we look at Europe and we have to exclude their distribution business, Reifendong GmbH, which can skew the numbers a bit,
Okay.
Q2 FY26 revenue was actually up slightly to 177 million from 171 million, but the profitability suffered.
The margins went south.
They did. The EBITDA margin in Europe saw a noticeable drop. It fell to 12.7% in Q2 from 14.8% the previous year.
And the company's reason?
They noted it was impacted by, overall challenging market conditions, energy costs, inflation, but it also signals this persistent struggle with their existing manufacturing footprint there.
And that challenging European picture,
Hmm.
it leads us directly into the biggest strategic item on the balance sheet, doesn't it?
The elephant in the room, the
Yeah.
exceptional items.
So for our listener, why do these exceptional items matter so much?
They matter because they are significant, non-recurring financial events that reveal a major strategic pivot the company is making. And in this case, the item is massive, foundational even.
And that is?
The intended decision to discontinue tire production at the Netherlands plant in Enschede by the summer of 2026.
Shutting down a major European manufacturing plant, that is not a minor decision. It signals a complete strategic shift in how they view their high-cost base in Europe.
Exactly.
So what was the immediate financial price tag for this necessary but obviously painful decision?
The total estimated cost for this restructuring recorded year-to-date in FY26 is $5,502.39 million.
Wow.
On the consolidated P&L statement. To put that in perspective for you, that's over 5 billion rupees in one-off costs.
5 billion rupees. That's nearly half of the entire EBITDA they generated this quarter. That is a staggering amount of money to absorb in just 6 months.
It is. This decision required full legal compliance, a request for advice to the AT&L Works Council. The cost was recorded across the half year.
How is it broken down?
About 3,684.74 million was recorded in Q1, and then after they reached a settlement with the Works Council in September, an additional estimated cost of 1,764.66 million was put on the books in Q2.
So the accounting department is taking the hit now, basically, provisioning for all the future closure costs, even though the actual cash payout for things like severance is expected to happen later in financial year 26-27.
Right, which shows a management team that's keen on recognizing the full cost up front. It gives them maximum clarity for the future.
And you see the immediate effect on the bottom line. This massive restructuring completely masked the impressive operational efficiency we were just talking about.
Completely. The consolidated year-to-date profit after tax at PAT margin, it fell dramatically to 2.0%.
Down from what?
Down from 4.7% the previous year's half year. And it's almost entirely due to these exceptional items. The underlying business is strong, but this strategic cleanup is just dominating the profit number.
So they're sacrificing that short-term profitability for long-term strategic clarity and efficiency in Europe.
Okay, so now that we've wrestled with that huge restructuring cost, let's shift gears. Let's look at the company's financial stability. Are they still disciplined, despite taking this large one-off expense?
Oh, they're impressively stable. The balance sheet strength remains solid. Their net debt divided by EBITDA remains low and stable at 0.8x across the half year.
And that low leverage is a key indicator of financial discipline, right? It means they aren't relying too heavily on borrowing.
Not at all. And that strong discipline is also reflected in their focus on free cash flow, or FCF, generation, and CapEx discipline.
What are those numbers?
YTD FY26 FCF was $3 billion, and YTD CapEx was $5 billion. For a global industrial manufacturer, that's a very healthy spread. It shows they're generating significant cash while still investing in future growth. And all this stability and this clean balance sheet, it must have given the board some confidence.
It did. It gave them the confidence to secure future capacity. On November 13th, 2025, the board approved raising funds up to $10,000 million. That's $10 billion.
Okay.
Via non-convertible debentures, or NCDs, through private placement. still subject to shareholder approval, of course.
That provides critical future funding capacity, maybe to smooth out those restructuring payouts or fund other strategic investments. But whenever you hear about raising new debt, it raises the question, how secure is their existing debt structure?
It's extremely secure, according to the notes. They currently have about 8,650 million in listed NCDs outstanding.
And these are secured?
Yes, these debentures are secured by a charge on movable fixed assets, and a portion is also secured by an exclusive charge on their registered office in Kochi.
So what's the key measure of security for the listener here?
The asset coverage ratio. This ratio, which measures how many times the value of their secured assets covers the debt, is calculated at 4.567x.
4.567 times. And what's the required minimum?
The required minimum, set by the lenders, is just 1.25x.
So they are almost 4 times safer than the required threshold.
Miles safer. The overall financial framework appears highly stable and really well managed.
So wrapping this all up, we see this incredible duality. The core operational finding is that, strong domestic demand and the impressive success of their premium brand, Vredestein, drove operational growth and efficiency gains we haven't seen in over 2 years.
Right. A great operational story.
But that story was largely overshadowed by the execution of this crucial, massive, and very costly strategic restructuring in their European manufacturing base, the Enschede plant closure.
The company has taken the short-term financial pain to secure long-term strategic clarity. They've demonstrated strong financial ratios, maintained very low leverage, and secured new funding capacity to navigate this transition.
So what's the final thought?
Given the significant exceptional costs for the Netherlands exit are now booked, here's a final thought for you to consider. This strategic shift means they are moving away from legacy European cost centers. So what will the true long-term impact on profitability and the regional revenue mix look like once these substantial costs are finally behind them in FY27? Will a leaner, more focused European operation deliver even higher margins than India?
That pivot from a European cost center to a profit engine, that really is the billion rupee story we'll be watching closely over the next few years. Thank you for diving deep with us today.